Imagine waking up to shocking news. China has just frozen the US dollar. The headline seems impossible, but it's real. Global markets are panicking. Investors frantically refresh their screens. Governments rush into emergency meetings. The world economy is holding its breath. China just froze the dollar. Now what? First, what does froze the dollar really mean? China didn't literally put US bills on ice. It means Beijing has essentially shut the dollar out of major parts of its economy and trade. Maybe Chinese banks were ordered to halt all dollar transactions, or companies told to use yuan for deals. Whatever the exact steps, the message is unmistakable. China is cutting off its reliance on the American dollar. The world's second largest economy just slammed the door on the US currency. To understand why China would do this, look back a bit. For decades, nearly everything in global trade, from oil to loans, was priced in US dollars. That gave the United States tremendous power, and it made others, especially China, uneasy. Beijing watched Washington use the dollar as a political weapon. When the US froze Russia's dollar reserves after the Ukraine invasion, it sent shivers through Beijing. If a major nation's money could be locked up overnight, what would stop the same from happening to China? In China's eyes, the dollar's crown was starting to look like a chokehold. China didn't wait around. For years, it's been quietly preparing for this moment. Beijing has slashed its holdings of US Treasury bonds, selling off America's debt to reduce exposure. It's also been hoarding gold to build a safety net that doesn't rely on the dollar. And most visibly, China has been cutting deals across the world to trade in its own currency, the yuan, instead of dollars. They even created new payment systems so they don't have to use US-controlled networks like SWIFT. The result? Today, over half of China's huge trade is now settled in yuan, not dollars, a shift that seemed unthinkable just a decade ago. China isn't alone in turning away from the dollar. All around the world, countries have been seeking alternatives to the greenback. Some are trading oil and other goods in their own currencies. Even traditional US partners are exploring different payment options. The ground of global finance is shifting under the dollar's feet, and its decades-long dominance is no longer assured. For global markets, this is uncharted territory. If China really shuts out the dollar, demand for the greenback could plunge. The US currency might tumble in value while China's yuan soars. Stock markets could swing wildly amid the uncertainty, and gold prices may shoot up. Whenever doubt reigns, people flock to the classic safe haven, and nothing is more unsettling than a shakeup of the world's reserve currency. International trade could face serious hiccups. For years, any two countries doing business often just use dollars as the common currency. Now, if the dollar is suddenly off the table with China, they have to negotiate something else to use, adding friction to every deal. It's like going to a market and finding your usual money is no good. Everything becomes more complicated. In the short run, that confusion could slow trade and make it more expensive. But on the flip side, without the dollar in the middle of every transaction, nations gain more independence. They won't have to worry so much about US sanctions or dollar shortages. It's less convenient, but it could also be liberating for them. If the US dollar loses value, Americans will feel it. Imported phones, clothes, food, you name it, would all cost more dollars than before, squeezing household budgets. Elsewhere, the effects will differ. Some countries might score cheaper deals buying directly from China in yuan, while others that hold lots of dollars could see their own currencies sink and prices soar. And global commodities like oil and grain could see wild swings until the world finds a new balance without the dollar as the anchor. This isn't just about money. It's about power. The dollar's dominance has been a pillar of American power for decades, letting Washington sanction enemies and borrow money globally to finance itself. If that dominance crumbles, the US loses some of its sway. Sanctions won't bite as hard, and paying for its deficits gets tougher if fewer investors want dollars. Meanwhile, China's clout could grow as more nations use the yuan. But most countries aren't eager to trade one boss for another. We might see them band together, supporting each other's currencies so they're not at the mercy of any single currency. The balance of global power is shifting before our eyes, and every capital in the world knows it. All this might sound far off, but it can hit your wallet. If you live in the US, a weaker dollar means your money won't go as far. Imported goods get pricier, and loans could become more expensive too. Your job could even be at risk if it relies on exports or foreign investment. If you live elsewhere, your country might gain some breathing room without the dollar's shadow, or face trouble if it was too dollar-dependent. Your savings and salary may shift in value as exchange rates jump around. In short, when a pillar of the financial world shakes, everyone feels the tremors. That headline about China freezing the dollar felt like a sudden earthquake in global finance, even though the fault lines had been forming for years. So, now what? Now the world faces a new reality. reality. Everyone, from governments to ordinary people, will have to adapt to a financial order unlike the old one. There's no putting this genie back in the bottle. China's move has changed the game for good. The world began the day in shock and ends it with a realization. The dollar's long reign may be ending and a new era beginning. That big question, now what, has no simple answer. The whole world will be wrestling with it for many years to come.